5th at to 2:11 now. Yeah, 2:11. We call it God's time on the East Coast. 7:11 p.m. UTC for our friends across the pond. And today we have with us. How do I pronounce it? I don't want to mispronounce it. Is it Calidora?
Calidora, that's right. Yeah.
All right, perfect. There we go. Calidora from Ostium Labs, and of course our wonderful host Marty, Brazil's lead vacation tour guide and boarding director.
The lead of the tourism board. I shill so much of Brazil. They should pay me. But today we have Calidor on. You want to give a little bit of an intro for people who don't know you? I think we know you, but new audience here for you.
Sure. Yeah, I'm Calidora, co-founder at Ostium. We are building the most liquid place to trade traditional assets through a perp on chain. So we're the only place you can trade gold, NVIDIA, S&P, NASDAQ, JPY, and BTC, all from one interface with the flexibility of a perp and best-in-class liquidity.
I think Cozy and I were talking about this a couple weeks ago, or maybe a month ago, and we were saying like we should just build an exchange where it closes so we can have the weekends off. And then I think I came across your protocol. Flow had messaged me, "Oh, check out Ostium," and I was like, "This is exactly what we were talking about." Maybe they were listening, but I did some research. You guys have been building this for a bit now. Is there a reason why the U.S. equities stop and why we're not doing 24-hour markets on those yet?
Because the underlying market is closed. So if you want to offer the underlying market pricing, you got to reference the underlying market hours. Unfortunately, I guess for most crypto natives, perhaps they are unaware of the nature of market hours outside of the US, or sorry, outside of crypto. So yeah.
Yeah, people in New York like their weekends and their dinner time hours. They don't want to be trading 24 hours. They are starting to bring 24-hour markets on Robinhood through a third-party provider, and the Nasdaq is starting to look at 24-hour markets. So will be an interesting growth period. I'm a little skeptical that the Nasdaq is going to go 24 hours as fast as people are saying it's going to be. You have any insights on that, on 24-hour markets? Do we even want 24-hour markets in TradFi?
I think the markets are rapidly hurtling towards 24 hours. It's not going to happen overnight, but I'd be shocked if in 5 years we're not there. So my view is I think the liquidity or good execution on 24-hour markets on chain, on markets that are not actually 24 hours in the underlying, will be achieved only once the underlying actually also becomes 24 hours. Right now, you have some places that are trying to offer 24-hour trading on markets that are not open. There's some benefits, but I'd argue there are more downsides than there are benefits to trying to do that. And I think the two will converge. You'll sort of get to a point where the underlying, where the on-chain solutions for those markets are liquid and effective over the weekends, precisely at the same time as the underlying markets are open on the weekends, which again, it'll happen in the next 5 years. I don't have any inside information there, but that is my strong suspicion.
We need a market over under 5 years for 24-hour markets. I'm there with you, but 24-hour markets, especially in New York, I think it's going to be a little bit of a harder push. It's definitely coming, but have some hoops and things to jump through. It's funny on 24-hour markets where the underlying isn't trading, you start to see those downsides, and I think you start to see it more recently with bigger moves. We saw PaxG wick like $500 across the board.
Yep.
I'm the king. I got liquidated on PaxG for a small liquidation on a $500 wick to the downside, and then the next day it was up, whatever, 5% or 2%, whatever it was for that day. You want to go a little bit into the?
I'll just maybe comment quickly on that. I think this is part of our core thesis with the architecture that we chose. If you're building a perp on top of a tokenized asset, you are subject not only to you're effectively as a trader trading 3 markets rather than 1. Just going by the gold example, you might be bullish gold and you might want to long it, but if you're trading a perp on top of Pax Gold, you not only have to track the underlying market gold price, you have to track the tokenized gold price, and then the perp on top of that. And so you wind up with these situations precisely as you described, and this happened on October 10th when all of the crypto liquidity dried up. Pax Gold wicked down to nearly 3,000. It was trading above 4K at the time, basically 25% drop or something close to it. And a lot of people who had rotated out of crypto because perhaps they were bearish or were concerned about risk to the downside, rotated into gold in an attempt to sort of manage their own risk and wound up getting their longs, which were actually directionally correct because gold was then proceeded to pump to pretty insane degrees the following week, but ultimately get liquidated because they unknowingly were forced to sort of track not just one, but two, but three prices. And then the crazy thing is the following week on the 16th, I believe that was the following Thursday, there were certain platforms where large positions in gold longs were then opened. It was right around the peak on gold. There was sort of a local peak and then a decline thereafter. And many people who then tried to short the top and who were again correct were unfortunately liquidated because certain large positions were entered into that spiked and wicked the gold price, the Pax Gold price up again. So what we're really trying to avoid with our architecture is traders being required to effectively track multiple markets rather than just the market they want to trade, and also being subject to the liquidity dynamics of crypto when really what they want to be subject to is the liquidity dynamics of the underlying market. It's no coincidence that Pax Gold wicked when the crypto market liquidity dried up, because it's ultimately following crypto liquidity rather than traditional market liquidity, which is really what you should be betting on if that's the asset you're trading.
Yeah, it wicked to 3,500 or wicked to 3,000, and then the next week it wicked to 5,000. So it liquidated users both ways. And shout out to the people who got those fills. But at the end, like you said, it probably does more damage than good. Over time, we can't just keep liquidating our users over and over again. And it's okay when the front end works and the UI and the API and you can cancel your order or keep or add or hedge. Sure, like yesterday, it all worked yesterday. But when you have a 10-10 moment and Exchange API goes down, the front end goes down, and you're just literally just sitting there doing nothing. I think even our co-located server went down for a bit on a few exchanges, and even like 5 minutes is a lifetime in the crypto world, and we just entered absolute free fall. I see you guys are listening. We have you pulled up here on the main page with gold right now. You guys have a bunch of TradFi stuff, but you also have crypto, and I'm assuming the crypto trades 24 hours, or the TradFi only trades. Is it futures hours or is it U.S. market hours?
We follow on stocks. We follow U.S. market hours. On indices, we follow futures hours.
Oh, nice. The whole offering. That's great.
Indeed.
I had a question, and I knew I had a couple questions from other people after they heard that you were coming on. In the U.S., if a brokerage goes down, you can just move your stocks from one place to another. But in this case, it's not necessarily that you're the beneficiary. You're not owning the underlying. You want to kind of clear that up for anybody who had that question?
Sure. It's very similar to the way it would work on any other. I mean, it's identical to the way it works on any other perps exchange. The instrument that you're trading is a synthetic representation of the price. So you are taking a position on the movement of the price, not owning the underlying asset, and that's sort of quite clear. So it's very different from than if you were buying spot, where you would actually own, underlying shares in the instance of an equity. You are betting on the direction of the price. So there's no redeemability for the underlying. That's very important. Also no sort of dividends as well. It's really made more for taking sort of shorter term directional positions on the direction of the price, not for redemption or for owning the underlying asset. So similarly to if, God forbid something happened to one of the large perp exchanges, you can simply take that position and transfer it over to one of the other exchanges. The same is true here.
Yeah, I mean, that clears it up. And then in terms of your Oracle pricing, how are you guys not getting these insane huge wicks like other players are? Are you using are you guys using Chainlink or is that even public who you guys are using for oracles?
Yeah, so it is public. On crypto, we use Chainlink. We use their data streams product. And on the traditional markets, we are using a Oracle that was built in-house. We're Stork Network. They're sort of one of the larger Oracle players. is operating the aggregator, so signs the price, and then ultimately we check against that to ensure the price isn't coming from a corrupted source. So they sign it, but the actual architecture of the price construction is coming from our sort of in-house constructed services and data agreements that we have in place. In terms of how we avoid the wicks, to answer that question, the wicks are coming from the fact, one of two sources. Either the fact that a perp on a traditional asset is referencing as their spot price a tokenized version of the asset. So going back to the Pax Gold discussion, they're not referencing Pax Gold perpetuals. They're not referencing gold as the spot price. They're referencing Pax Gold, which obviously is a very different liquidity profile from the $30 trillion gold market. Pax Gold is a tiny, tiny fraction of that, and so obviously much more volatile and subject to the to changeable prices, shall we say, or potential large deviations in price from large positions that are entered into, either buys, people buying in substantial size, not sort of averaging in, or the opposite. So wicks either come from the spot price you're referencing being in a liquid sort of derivative or tokenized version of the spot, which is not the case for us. We reference the underlying market, or they come from the perp instrument, even if the spot is, let's say, referencing the underlying, the perp on top of it, recreating its own liquidity. And what I mean by that is there's a native order book on the exchange. There are market makers, posting onto the order book, creating effectively like a mark price that is to some degree away, some either, above or below the index price that's coming in from the underlying market. And obviously that order book liquidity for the perp is going to have thinner liquidity than the underlying market, for, I think, hopefully obvious reasons, right? If you're trying to recreate, let's just maybe take, Bitcoin, if you're opening a new perp exchange, you're obviously not going to match Binance or, Hyperliquid's liquidity from day one. You're starting from scratch. So you're obviously going to be more subject to potentially large orders wicking the price and moving through the order book and clearing out orders. The same would be true if you are even a very liquid perp exchange, but you're listing a new asset, which would be a traditional market asset. So to summarize, the wicks come either from the sort of or downstream of the spot price moving substantially because you're referencing a tokenized version of the asset with a different liquidity profile, or the perp itself moving in price because the liquidity on the books for that perp on the exchange itself is thin. We have neither because we have a very different model. We don't have a freely discoverable perp price on Ostium. You can think of it as almost closer to a synthetic spot position, a synthetic levered spot position, than it is a proper perpetual, in the sense that we pull pricing from the most liquid source, namely the underlying market, and then we allow people to execute against that. We pull in not only the mid price, but obviously an aggregated bid or ask, and so execute people at that bid or ask, depending on the direction of their trade. So you're not seeing wicks that are coming from on-chain price behavior. You're simply seeing sort of a very, very close mirror of the underlying price directly. There can be wicks, obviously, in the underlying market. It's just far less frequent and require far greater moves in order to generate that, simply because those markets are so much more liquid.
Yeah, we had a live question come in from M. He said, "How do they deal with expiration dates? Are users expected to rebalance every time?" But I think you guys are offering a perps product, not a dated futures product, correct?
Yes, great question. So yeah, it is a perpetual swap. It's a perpetual instrument. So you don't have to handle dealing with expirations. This is what we think makes it such a much better instrument than an option or dated futures. Those obviously are the primary instruments that are used by consumers in in most places, or certainly in the US, let's say, and then in other regions like India. And CFDs, which I can talk a little bit more about, actually have many very similar properties to perps, in the sense that they don't expire, and they're as a result very, very popular in many regions in which they're offered. But if you're comparing this to some of the other instruments that are quite commonly used by other consumers, the dated options and the dated futures, we think a perp is a much easier to understand instrument. On the option side, you could track Greeks. It's a lot more complicated to price an option. And obviously there's an expiry baked in. Perps are, a linear instrument. They're a Delta One instrument, so simpler to understand. And then on the future side, yes, they're linear, but there are expiries which you have to handle, rolling over. Here, the system rolls over automatically, so you don't need to worry about rolling things over. So hopefully a much more easy to understand instrument where you don't have to handle expiries.
Yeah, I think it's hard for retail to understand simple expiries or even managing the position. Like
100%.
in the option space, you have some situations where you have calendars on, so you're long one expiry, short another, vice versa. And we had a situation, I think it was last main expiry or a couple months ago, was like we were going to be at 110 initial margin, maxing out our margin on a huge account if we let this roll over at expiry. So the exchange will let you put on the trade because technically you're hedged, long, short, different expiries. But when you look at it at settlement, your portfolio absolutely swings the other way, and you're just mega long one expiry or mega short that expiry. I think we ended up being mega short, so we had to hedge before the expiry, and it just became, for us is a one-click button. We build in-house systems to notify and one-click delta hedge for us, but for like a retail user, it's much more complicated than it needs to be. Perps are, monkey sees red, green, click the button, up, down, seems much more easy. And from what I've seen, they don't care about paying funding. Funding can be 1%, 2%, 3% on some of these meme coins every 8-hour cycle. And at the end, they just don't care. In terms of your guys' funding, did you see any outsized funding rates on like a 1010 or like a yesterday versus any other exchange, or how are you guys pricing your funding
Yes.
rates?
So it's a great question. Just on the point about, consumers generally not really caring about funding. I think that's true up until a certain point, and it's true when assets are extremely volatile, but the tolerance, I would say, for high funding rates diminishes the lower the volatility is on the asset. Nobody's going to be willing to pay 50% funding on the euro on a normal day where it moves 20 basis points in a day, shall we say. It's not like a meme coin where people are betting on sort of these dramatic moves over a very short period of time. I would argue even in that case, people might be willing to tolerate it, but if there's an alternative that has lower and more predictable funding rates, people will gravitate towards that solution over the long run. But the sort of general tolerance for not only the magnitude, but also the variance of funding rates is diminished on traditional assets. And that sort of brings me to answering your second question, which is, how does the system work for us? Did we see very high funding rates? We explicitly have implemented a system that brings in sort of the funding costs or the holding costs of the underlying market to users, rather than having variable funding rates that are downstream of the liquidity conditions on Ostium itself. And it just maybe explain why, because we used to have funding rates. We still have funding rates on crypto because there's a pretty robust market for arbitraging those rates, but it just simply doesn't exist on the traditional assets that we have, and certainly doesn't on the longer tail of traditional assets like a copper or palladium. And we found that when we had funding rates, the rate that was sufficient to incentivize people to come in and take the other side was very high, because there wasn't much infrastructure to do so. It's kind of these one-off people who'd come in and try to arb the funding and hedge themselves. And moving collateral between on and off chain is much more complicated than between your on-chain Perp exchange and a Binance. So the rate had to be very high to incentivize people to sort of run these strategies organically. And ironically, the rate that was high enough to incentivize people to do that was basically the same rate that would kill the demand on the long side or the more popular side. So it's this terrible catch-22 where rather than creating supply on the unpopular side, you wind up just killing demand on the popular side. And again, you can sort of the threshold that kills that demand is different depending on the asset and the vol of the asset. If it's a meme coin, that threshold might be very high. People might be willing to pay 200% a year, 300% a year. I don't know, but the threshold on a Nasdaq or on a euro is going to be much lower. Obviously, euro being lower than the Nasdaq given the volatility. So the way it worked for us is we instead pull in and we pipe in the holding costs from the underlying market and add a very small sort of consistent premium on top. And so they mirror the underlying market holding costs, or very closely do, akin to the way we do with pricing, rather than sort of being subject to the sort of random walk of, in the very short term, I suppose, whatever short enough period of time, random walk of of liquidity dynamics and sort of demand profile, one direction or the other on the platform itself. Hopefully that makes sense.
Yeah. Some retail is happy. I've seen 1,000% annualized funding rates. Retail does not seem to care when it's a new token, a meme coin, something of the hype. They simply just do not care whatsoever. What's your biggest traded asset in terms of volume? Is it Bitcoin, or are you seeing a lot of uptick in like a SPX or?
It's very cyclical. It really depends on what's moving. So over the last 2 months, the most traded asset has been gold by a pretty long shot. Before that, at some point over the summer, there were a few very, very large positions held over periods of time on NASDAQ and S&P, largely NASDAQ, actually. Earlier in the early summer, late spring, S&P was very frequently traded. And then also, I mean, Bitcoin is also very consistently traded just because of our audience is still predominantly crypto natives who want access under a single umbrella to trading other assets. So it really depends. It depends on sort of what's moving. When we had a lot of volume on, especially the last, in October when there was a crazy metals rally and gold was hitting historic highs. We also saw a lot of downstream volume on other metals like copper and palladium and platinum, silver as well, which was sort of mirroring the gold rally or somewhat delayed. So it's highly dependent, to be honest, on, you could probably guess what the most traded assets are at any given point in time by what TradFi asset your CT timeline is talking about. It's pretty big with like what people are talking about on Twitter or in your group chats. So it's been gold mostly the last month or so, but varies.
Just follow CT sentiment and counter trade them. You'll probably win. I did a vote yesterday, like end of the week, ETH, over under 3,300, and it's like 70% under or something. It's like, guys, we're $200 over that price target. The emotions get to people and they start trying to short into the bottom. You could have shorted into the bottom a few times yesterday and gotten away with it, but if you held through overnight or in the Asia morning, you got absolutely hosed. In terms of your user base and audience, is it all crypto native, or are you guys also seeing some TradFi people come over and try to play in the crypto pool? I feel like in the options world, a lot of the smart cookies left TradFi and came into options because the spread is much wider. It's much more lucrative. You can size in appropriately. There's RFQ. There's some things that are super familiar to them. There's OTC, but getting TradFi people to come over and trade perps is a unknown world to them. I'm wondering how you guys are navigating or what you guys are seeing.
Yeah, it's a good question. So I would actually answer the question by perhaps qualifying the term crypto native, because I think the space has gotten so large that it's easy to conflate, like a meme coin trader who's mostly trading on Solana and, in the Phantom wallet with someone who's an active perps trader and comes from an FX, maybe comes from an equities or an FX background. Those are two very, very different profiles. And I think they've sort of started to lump them all into the same category. And I think the space sort of merits maybe like a resetting of what we determine as crypto native. Some people were quote unquote crypto native, it's bought Ethereum back in 2015. And other people are like made their money in the 2017 rally, and other people only entered in the last, year or two trading meme coins, but they're so deeply entrenched in the space, at this point they're sort of crypto native, and that's their first experience is trading crypto. So maybe the better way to define it is like perhaps you're crypto native if like the majority or the first sort of meaningful experience trading or sort of navigating the markets happened in crypto. As for our user base, so we're definitely not like we're not really a product that's used by kind of like meme coin traders. I would say we are certainly whale dominated. Volume is very skewed towards sort of large users. These are people who've done. We can set the threshold somewhat lower. Like people enter the VIP program when they've crossed 10 million in volume. So if you cross 10 million, you'll see a VIP button pop up on your screen, and you'll be able to fill out information, and we'll talk to you. We will talk to you anyways, but we'll send you merch and set up a chat.
10 million to talk. That's the number.
We'll talk to anybody. I mean, we're active in Discord. Like, you message me on X. My DMs are not always super clean, but I always do my best to try to answer any message or comments or whatever. So, we'll talk regardless, but we make we have a programmatic system for reaching out, once you cross that number. But I'd say sort of like the whale threshold really in my mind is more like 100 million in volume. And the platform's definitely sort of dominated by that. I wouldn't say we have very large, long tail of smaller users, which is something that will change over the coming weeks and months. And those sort of larger users who dominate the platform are disproportionately people who are actively tracking macro. They typically, the typical user is someone who cut their teeth on crypto, and sort of fits that definition of being crypto native in the sense that they learn to trade the markets and follow the markets in the space. But they, for better or for worse, over the last few years have either by desire or simply by the market forcing them to, forcing their hand, have started, dramatically expanded what they follow in the markets to include. And maybe this is now sort of like a mainstream position, but certainly was a couple of years ago, obviously tracking Fed rates, tracking inflation, tracking the geopolitical conditions, broader sort of tech trends and market trends that extend far beyond, the 4-year Bitcoin halving cycle or the niche activities of certain or, market moves of certain altcoins. They're thinking more from a top-down sort of macro perspective, and they want a place to express those views on the other assets that they wind up developing a position on, simply because, they're tracking macro top-down. So they're certainly going to have an opinion on gold if they have an opinion on currency devaluation and inflation and M2 supply and all that sort of stuff. But they don't want to off-ramp. So that's sort of like the core characteristic user. I would still call that person crypto native, but not crypto native in the degen, CT, or perhaps meme coin direction. They're like a different flavor of crypto native.
Yeah, we call them pro retail.
Yeah.
So they're not retail, they're not pros, they don't have a yard of capital, but they know a little bit more of what they're doing. So
that's a good yeah.
Always good to have a good baseline of pro-tail users. So Vol, I think if it's the Vol that I know is a Brazilian fella, but he said on the TradFi markets there's a rollover fee, then linked to your GitHub. I'm not going to click any links, but then he said, would you mind elaborating on what happens to that fee? As in, is it transferred to the users on the other side, or is it the platform itself? And then shout out on the big OI increase and usage in general. He's probably a pro-tail user.
Yes. Okay. So, Mr. Pro-tail, great question. So the way the fee system works is we pull in sort of holding costs from the underlying market and then pass those on. That's likely what you're referencing in terms of where it accrues to. It accrues directly to the vault. So sort of two regimes. If the vault is under collateralized, which simply means that the accumulated, this is going to be it's a little bit of a mouthful, but means that the accumulated net P&L of traders has been to the sort of detriment of LPs, which does not necessarily mean that the price of OLP is necessarily down, because fees accrue to OLP. So 30% of opening fees always accrue to OLP, independent of what's going on in terms of trader P&L. But if traders have in the aggregate made money, then the collateralization ratio is beneath 100, which is currently the case. Under that regime, all of the rollover fees, so namely the fees that are collected from one of the sides from traders for holding their positions, accrue to Vault LPs. If the collateralization ratio goes above 100%, which simply means that, again, under both regimes, the amount that LPs have made from fees in aggregate may exceed the amount that LPs have lost from being the other side to traders. So the collateralization ratio doesn't tell you anything per se about the historical performance of OLP. It simply tells you about whether in the aggregate traders have lost or made money, and they have in the aggregate sort of made money, hence the C ratio being below 100. Slightly more complicated than that, but I think my explanation is already sufficiently complicated, so I won't go into more detail. You can read the docs. But when it's beneath 100, then all of the rollover fees, the holding costs, all accrue to OLP holders. When it's above 100, it accrues to what's called the buffer, which is sort of this pool of capital that can or cannot exist. It only exists when the collateralization is above 100. And then the vault, the rollover fees accrue to that buffer. under that scenario. Otherwise, and then the thing that remains constant above both regimes is the 30% of opening fees going to OLP. So the fees are pulled in from the underlying market, and the recipients of those fees are not those who are on the other side. They are the vault LPs under the current regime.
And then what are the current open and closing fees in BIPs?
Great question. So we don't charge any closing fees. The closing fees are always zero. We want the P&L that you see to be the P&L that you get. We don't want any hidden fees. So if you have a position open and you see a P&L, that's it. You're not going to get charged again. So the fees are only charged at open, and the fees vary by asset. Sometimes people find this confusing, but I do think the market will prove our model correct. If you're trading crypto, if you're a crypto-only exchange, it sort of makes sense to have maybe flat fees. They can vary based on fee tier, but flat fees across the board. It's very different in traditional assets. The fees that you would be charged on an IBKR to trade gold versus trade NVIDIA versus trade JPY are very different. And so again, we try to mirror with sort of a small markup for doing it on chain, the fees from the underlying. So on something like gold, the fee is, I believe, it's 3 bips at open, nothing at close. So you can think, if you're comparing that to other exchanges that charge both open and close, you can think of that as 1.5 bips on open, 1.5 bips on close. On things like stocks, the fee is 5 bips, so again, something like 2.5. On crypto, it's 10, so slightly higher fees on crypto, so it's like 5 and 5. So it depends on the asset. You can generally think that the fees are more or less correlated to the volatility of the asset, but they're not dynamic. So 5 on stocks, 3 on most commodities, 10 on crypto, 2 or 3 on FX.
Do you have fee tiers, or it's just that opening fee? You have like, if you do 10 million, you get a VIP tier, or you're just still doing fixed?
Not
for
yet,
all users?
but there will be fee tiers. It's something we're working on, and it's coming down the line, but they're not live yet.
Well, that's good. This is like the most live questions we've had in a while. Usually, it's good for the founders to come on and show face and talk, but usually we have traders on, or it's more of an options talk. It's been a while since we had an actual protocol on. We started the show, cozy, 2 years ago now? 2.5 years ago? It was a long time, maybe 3. And we started with protocols, and then we moved into traders, then we moved into options only, because that was a new hype with Lyra, Premia, Avo, all kind of coming in. Yep. And then now we're expanding to pro-tail traders, options traders, protocols, just being the face of crypto. I know we're pushing 32 minutes, and you had to go at the top of the hour, but any questions for us? Anything you think the viewers should know about you or the protocol?
Yeah, I mean, we're going to be probably the most important update is we listed a bunch of new assets in the last 2 weeks after sort of demand from our users and prospective users. So if you go to the stocks section, so you'll see we used to just have Mag 7. In the last 10 days, we've listed crypto stocks, so Coin, Hood, Circle, and Galaxy, and then several DATs as well. So MSTR, SBET, and BMNR. Those are all available for trading. So if you guys want to try them, I think there's been quite a bit of demand. So if you trade it, if you have feedback, there are things you like, there are things you don't like, you should always reach out. And then you should also expect to see a number of new assets coming down the line as well as some pretty sort of important and exciting updates on the liquidity model side. There's also some good questions that were asked. The most recent one on rollover fees and how all of that accrues. We've taken we've been updating the docs significantly to, I think, provide a little bit more clarity and technical detail in all of these implementation aspects. And we'll also be releasing sort of a dashboard that allows people to do a little bit more, let's say, sleuthing on sort of the net positions, exposures of OLP, and sort of the general protocol mechanics. So for those who are mechanism design nerds or want to dig in deeper, we'll be providing more tools to make that easier for users. So and then product wise, if you guys have feedback, you guys try the product, there's things you like, things you don't like, we're always all ears. We are very eager to hear any product feedback, so always feel free to DM me on X. I'm at Kaledora, just my first name, Kaledora, or Flow Trader TM, also very active on X. We'll get back to you and take into account any feedback you provide.
Sweet. Thank you so much for your time. Thanks for coming on.
Thank you
Yep,
guys.
really appreciate you joining us today.
Thanks.